This video is about one of the Nobel Prize in Economics, which was awarded in 1999 to Robert Mundell. Welcome to the interactive session on analysis of monetary and fiscal policy under different exchange rate regimes and analysis of optimum currency areas. Brought to you by Joyce Juliana. Let's start by understanding exchange rate. To understand exchange rate, you really need to grasp one concept: foreign exchange, i.e., foreign money, another commodity we bought and sold. This is where the term foreign exchange market comes from. So there must be one to buy the currency and the one to supply it. On the demand side, what reason that people possibly have to purchase foreign exchange or foreign money? Generally, there are three major reasons. First, people want foreign money for travel and tourism. Second, foreign money is needed for trade to buy foreign goods and services. And third, foreign money is needed for investment purposes, be it financial investment like purchase of foreign denominated financial assets or real investment like building factory overseas. A change of any of these three components will alter the demand for foreign exchange. A surge in tourists going to Paris, for example. These tourists will need euro and creating increasing demand for that currency. Similarly, if US company likes to buy goods and services from Paris, and for that purchasing euro, the demand for euro would increase. Now let's get back to the idea of foreign exchange market, with the euro being the foreign exchange of foreign money. Initially, there is a certain supply and certain demand in euro, and the equilibrium price of this market is called exchange rate. What happened to the value of euro when there is more tourist travel or more US company purchase euro-denominated goods? There would increase demand for euro and create new equilibrium price or exchange rate. As was any commodity, when the demand for euro increases, its value increases, and the exchange rate in terms of the US dollar per euro increases. This is called an appreciation of the euro. When dealing with bilateral exchange rate like this one, that is to say, the relative value of two currencies, it is necessarily the case that one currency becomes stronger or more valuable relative to the other. In this case, the euro is increasing in value relative to the US dollar, the other currency that decreasing in value or depreciating. In this example, if the euro is appreciated, the US dollar getting relatively weaker or depreciating. Exchange rates are called floating or flexible when they fluctuate based on market supply and demand. It's tempting to think that it's good when your currency gets stronger and bad when your currency gets weaker. However, exchange rate fluctuations have different impact on exporters and importers. Exporters like weaker dollar, so they can sell more goods in euro and make more in US dollar. Whereas importers like stronger dollar, so they can buy more goods in euro, and they can get more for less. One way to avoid confusion and uncertainty is to have fixed exchange rates, maintaining the exchange rate at a specific level. In the past, all currencies were fixed to gold. Today, a country can fix its value to another country's currency or peg its exchange rate. But that requires government intervention. A central bank such as Fed and ECB, European Central Bank, will buy and sell foreign currency to influence exchange rates to keep things balanced. But unfortunately, it can be hard to keep fixed exchange rates fixed. Government must be prepared to provide whatever amount of money is demanded at this fixed price. Not to mention that it also lost its independence because the country is locked in or pegged to another country's currency. Mundell considered that in a system of floating exchange rate, monetary policy like interest rate adjustment is highly effective, since monetary expansion will lead to a depreciation of the currency and consequently to an increasing of exports and income. Contrary to what many economists before him had believed, Mundell considered that when exchange rates are fixed, both monetary policy and fiscal policy should be used. The monetary policy should be used to ensure equilibrium in the balance of payments, and the fiscal policy, like GDP target and tax cut, should also be used to adjust aggregate demand to attain full employment. To address the fixed versus floating exchange rates, Mundell pointed out the so-called impossible or incompatible trinity of free capital flow, fixed exchange rates, and independent monetary policy. Under the trinity, people should be able to buy and sell currencies without government restrictions, and there will be no confusion and instability in the economy, and the government will be able to boost or slow down economy by changing money supply. As it is an impossible trinity, only two of these can be achieved. For example, say government wants to keep inflation low and allow free traded currency, it must settle for a floating exchange rate instead of fixed exchange rate. Moving further, Mundell brought up the issue of optimal currency area. He put the question, should all national currencies work in a floating exchange rate regime? Why not a common currency? When European countries banded together to form the European Economic Community, which became European Union, it allows people and goods to move freely across borders. They also sought to fix their exchange rate to each other. The diverging fundamentals would force one or another members to devalue. Therefore, in 1999, 11 European countries gave up their own currencies to adopt a single currency, the euro, to be issued by the European Central Bank. The benefit was eliminating the difficulties associated with having multiple currencies. It facilitates trade and closer integration of capital markets. But the cost was a loss of independence of these European countries to direct their own monetary and fiscal policy. Mundell's analysis highlights the importance of togetherness. If countries are already moving in a union, a currency union makes sense. But it also highlights that the fundamental of each member of European Union should also converge, and that labor and capital mobility are important. People and resources need to be able to move from one European Union country to another to maintain full employment and equalize prices of tradable goods. So how to know if countries in an optimum currency area and therefore improve efficiency in the functioning of currency relations? If there are high mobility of labor and capital, and price and wages flexibility across the region, and governments is able to transfer funds and adjust taxations across the region. Mundell realizes that in the real world, a currency is a symbol of national sovereignty, and therefore the creation of a new currency arrangement should be accompanied also by political changes. Where political integration or unity is underway, an optimal currency area is effective. Thank you for watching.